Welcome to the Deep Dive, where we cut through the noise and get straight to the impactful insights for you, our dedicated listener. Today, we're dissecting the Q2 FY2025 results from Seacoast Banking Corporation of Florida, ticker SBCF, following their call on July 25, 2025. This isn't just a summary, it's a deep dive tailored to help you understand what truly moved the needle this quarter.
Exactly. We're going to unpack what drove Seacoast's, surprisingly strong performance, their strategic moves in Florida's fiercely competitive banking landscape, and what management is signaling for the rest of the year, maybe even into 2026.
Yeah, because this quarter had some significant beats, didn't it?
Oh, absolutely. But the market reaction was, shall we say, a bit more nuanced than you might expect for such strong numbers. We'll definitely explore why that show-me approach is still lingering.
Okay, so let's jump right into those standout results then. Seacoast didn't just meet expectations this quarter, they really outshone, delivering a powerhouse Q2. What were the most striking figures for you?
Well, right off the bat, they had adjusted earnings per share, 52 cents. That's a substantial 23.8% beat over the $1.42 consensus. That immediately signals, real operational strength.
23% is huge.
It really is. And on the top line, net revenues hit $151.4 million, topping consensus by a healthy 4.3%. What's even more impressive there, though, is it translates to a robust 20% growth year over year and an 8% increase just quarter over quarter.
Wow, so they're not just tightening belts, they're actively expanding.
Exactly. And the net interest income, which is, the core revenue driver for any bank, was also robust at $126.9 million. That's up a healthy 7% quarter over quarter.
That's a strong indicator, isn't it?
It definitely is, and it's driven by that net interest margin, or the M. It expanded 10 basis points quarter over quarter to 3.58%.
And maybe just quick reminder on basis points.
Right, good point. 1 basis point is 1/100th of a percentage point, so 10 basis points is 0.10%. And what's particularly encouraging is that their core NM, which excludes some of the acquisition accounting noise, also improved, up 5 basis points to 3.29%.
Okay, so the underlying business is genuinely generating better returns.
That's the key takeaway there, yes.
Yeah.
Not just M&A accounting giving it a lift.
And beyond the NIM, their pre-provision net revenue, or PPNR, basically the operating profit before loan loss provisions, that saw a healthy increase too.
Very healthy. Up 19% quarter over quarter and an even more impressive 35% year over year. Hit $60.2 million. Shows strong underlying profitability.
Right. And coupled with that, the credit picture looked better.
Indeed. And this is important. The provision for credit losses decreased significantly, down to $4.4 million from $9.3 million in Q1. That indicates, stabilization, maybe even improvement in credit quality.
And loan growth, still chugging along.
Still solid. Annualized 6.4% quarter over quarter, and importantly, supported by a very healthy pipeline, $920.9 million. Lots of potential there.
So on paper, those numbers are undeniably strong across the board. Fantastic quarter. Yet the stock's initial pop, nearly 4% intraday on the call day, it just faded. Closed down slightly, 0.17%. That tells a deeper story, doesn't it? What's going on behind that market reaction?
Exactly. That's the puzzle. When the market sees strong results, but adopts this kind of show-me stance, it often points to something beyond the current numbers.
Like execution risk.
Precisely. Especially in regional banking, past M&A integrations haven't always gone smoothly across the sector. Sometimes there are unexpected write-downs, or maybe synergies take longer to materialize.
So investors are cautious about the M&A piece here.
I think that's a big part of it. That muted reaction suggests investors want more than just one good quarter. They want sustained proof of successful M&A execution, especially with the big Villages deal coming up, and they want to see credit normalization continue.
So every detail of the Heartland integration and the upcoming Villages one will be under a microscope.
You bet. Everything from retaining key staff post-merger to how quickly those new low-cost deposits actually impact the bottom line, and crucially, how credit quality in the acquired loan books holds up.
Okay, that makes sense. So they've delivered these impressive numbers, but the underlying mechanics are key. What specific strategies are they deploying to achieve this margin expansion and loan growth, especially when deposit costs are a headache for so many banks?
That's the crux of it, and it really highlights, I think, management's disciplined execution. They explicitly pointed to disciplined deposit pricing. Think about that.
In this environment.
Right. While many regionals are fighting tooth and nail, often raising rates to keep deposits, Seacoast managed to decrease their total deposit costs. by 13 basis points quarter over quarter, down to 1.80%.
That's a significant win.
Right. It speaks volumes about their relationship banking model, the stickiness of their customer base, and frankly, their willingness not to chase every hot money deposit dollar at any cost.
So quality over quantity on the deposit side?
Seems like it. And at the same time, their loan yields also expanded by 8 basis points to 5.98%. So they're widening that crucial spread, what they earn versus what they pay from both ends. That's strong asset liability management.
So it's not just market tailwinds, they're actively steering the ship.
Exactly. Very deliberate.
Okay, that's the margin side. But what about the loan growth itself, that 6.4% annualized figure? Is it purely organic, or is there another strategy helping them originate quality loans?
Well, it's not just organic, though that's certainly part of it. A large chunk is attributed to Seacoast's multi-year strategy of recruiting top banking talent, often from larger institutions.
Ah, the talent acquisition play.
Right. Instead of just chasing volume, which can sometimes lead to credit issues down the line, especially in a hot market like Florida, they seem to be playing a longer game, poaching experienced bankers who bring established, high-quality client books with them.
That drives higher quality loan production then.
That's the idea, and deepens customer relationships. Plus, the Florida economy is still strong, which helps support demand.
And did they mention efficiency?
They did. The adjusted efficiency ratio improved nicely, down to 55.4% from 59.5% last quarter. Remember, lower is better, their costs less to make a dollar of revenue. So another positive sign on cost control.
Okay, so managing organic growth well. But M&A is clearly a big part of the story too. Tell us about these strategic acquisitions.
Definitely a significant pillar. They successfully closed the Heartland Bank shares deal on July 11th. That adds about $777 million in assets, 4 branches. Integration should wrap up this quarter, Q3 2025.
So we'll see the impact soon.
We should. But maybe more notably, they have the definitive agreement to acquire Villages Bancorporation, VBI. That's targeted to close in Q4 this year.
And that one's substantial.
It is. Around $710 million in assets, 19 branches, and critically over 50% deposit share in the Villages market.
50% deposit share in the Villages. That sounds powerful. Why is that specific market so important?
It's about the type of deposits. The Village is known for its affluent demographic, retirees, often with significant savings. These tend to be very stable, low-cost core deposits, less sensitive to rate chasing than, say, commercial deposits.
So it provides ballast, as they say, a really sticky funding base.
Exactly. That's gold in today's banking environment. Management expects these deals to deepen that low-cost funding in high-growth Florida areas and then layer on treasury and wealth management cross-selling opportunities.
Which boosts fee income and makes NII more resilient.
Precisely. They project these deals could add about 10 basis points to the core NII once fully integrated. That's a material long-term benefit.
Okay, sounds strategically sound, but M&A always carries integration risk. Retaining customers, key talent. Did management address how they mitigate those common pitfalls?
That's always the key question, isn't it? They emphasize their proven integration playbook. They've done quite a few deals now and highlighted their experience in making these transitions smooth. Focus on cultural fit, retaining key people from the acquired banks.
So confidence from past success.
It seems so. And they stressed a disciplined approach to picking targets with strong, compatible franchises. The Villages deal, for instance, is right next door geographically, which helped smooth out operations and client transitions. Full integration for VBI is planned for the first half of 2026, so they have a clear timeline.
Okay, managing growth well, both organic and acquired. But with all this activity, asset quality is paramount. What's the credit picture telling us? Any cracks appearing?
Not according to management, and honestly, the numbers back them up. Asset quality looks sound. They keep talking about their fortress balance sheet strategy, and it seems to be holding.
What are the key metrics there?
Non-performing loans actually declined to just 0.61% of total loans. That's very healthy. Net charge-offs loans written off were exceptionally low at $2.5 million, or just 9 basis points annualized.
9 basis points is tiny.
It really is. And the provision for credit losses, as we mentioned, normalized significantly compared to Q1. This stability also comes after they cleaned up by selling off a consumer fintech portfolio last year that had been causing some NCO noise.
Right, I remember that. So that cleanup is paying off.
Looks like it. And their Tier 1 capital ratio is strong at 14.6%. Lots of cushion there.
Okay, feeling good about the present. What about the future? What guidance did management provide? And are there any big ifs in that outlook?
They gave a pretty optimistic outlook for the rest of 2025. They see continued modest NIM improvement, targeting an exit core NAP around 3.35%, maybe hitting 3.45% once the acquisitions are fully factored in.
But there's a catch.
Well, a key assumption. That projection assumes the Fed cuts rates twice more this year, once in September, once in December.
So if those cuts don't happen or get delayed,
then that NIM trajectory could look different. Definitely something for investors to watch closely. On expenses, they guided Q3 adjusted expenses to $92 to $94 million, reflecting the Heartland integration and ongoing cost control.
and growth expectations.
For the full year 25 and into 26, they're projecting mid to high single-digit organic loan growth and low single-digit organic deposit growth. Again, emphasizing quality, relationship-based core deposits.
Okay, now this is where it gets really interesting for understanding the regional banking space. How is Seacoast navigating the competition, especially in Florida's hot real estate market? Why should listeners care about these dynamics?
Great question. Because Florida is intense, especially in commercial real estate, CRE. You've got large banks that pulled back in 23, 24, now jumping back in aggressively.
So more competition, squeezing spreads.
Exactly. Spreads on high-quality deals are getting compressed, sometimes below 200 basis points. That's tight. Management, James Stallings, the chief credit officer, specifically said they're being very selective, focusing on risk-adjusted returns, supporting their best sponsors, not just chasing any deal to hit a volume target.
Discipline over volume, even if it means leaving some business on the table.
That seems to be the message. Avoiding future credit headaches is the priority.
So how do the acquisitions fit into navigating those pressures? Heartland, Villages, how do they help optimize the balance sheet?
They're absolutely crucial. Think of them as a strategic counterweight. Management would call them super valuable deposit franchises. They bring in that stable, low-cost funding base we talked about.
Which gives them more firepower.
Right. Seacoast's long-term plan is to nudge its loan-to-deposit ratio up from the low 70s now towards 80%, maybe eventually 85%.
Yay.
It means using that cheap deposit funding more effectively, deploying it via those talented banker hires and quality loan growth.
So it's about remixing the balance sheet for better profitability.
Precisely. And they also expect a lift from repositioning their securities portfolio in the second half of this year, tweaking their investments for better yields. It's a multi-pronged strategy.
Okay. So strong financials, clear strategy, disciplined management. But that muted market reaction persists. What's the final takeaway here? And what are the absolute key catalysts for listeners to track?
Yeah, that muted close tells us investors remain firmly in show-me mode. They need to see the proof in the pudding, especially on M&A integration.
Execution is everything.
It really is. So for you, the listener, keep a laser focus on these catalysts. 1, the VBI acquisition closing smoothly and clear communication on synergies. 2, seeing Heartland's cost savings and revenue benefits fully realized by year-end. 3, watch that NIM trajectory and deposit beta, how sensitive their funding costs are if rates do change. And 4, continued stable credit trends.
Those are the proof points the market is waiting for.
Absolutely. Hitting those markers will be crucial for Seacoast to really stand out and potentially outperform other regional banks.
All right, it's time for our This Is Not Financial Advice segment. Totally speculative, maybe outrageous, but plausible trade ideas based on our discussion. Remember, folks, this is strictly for entertainment and thinking conceptually.
Okay. Considering the strong Q2, that bullish tilt beneath the conscious market surface, and how critical M&A execution is, here's an outrageous but plausible thought. What about a calendar spread on SBCF options? Specifically, you'd buy a longer-dated call option, maybe expiring early next year, and simultaneously sell a nearer-term call option, perhaps expiring just before or around the expected Q4 close of the Villages deal. Same strike price, roughly.
Okay, a calendar spread timed around the VBI close. What's the outrageous but plausible rationale?
The market is clearly waiting on M&A execution.
Yeah.
If, and it's an if, the VBI acquisition closes smoothly, maybe even a bit early in Q4, and management nails the communication on initial synergies, you could see a significant positive re-rating in the stock pretty quickly.
So the trade is betting that the market hasn't fully priced in successful integration.
Exactly. It's anticipating a potential pop once that execution uncertainty lifts. You're betting that the nearer-term option you sold expires worthless or cheap as the market waits, while the longer-term option you bought captures the potential upside if the VBI news is good.
It's essentially a bet on the long-term strategic narrative finally overcoming that near-term investor caution once the proof arrives.
Precisely. Plausible? Maybe. Outrageous. A bit. Definitely not financial advice.
Definitely not. So to wrap up our deep dive, Seacoast Banking. A quarter marked by disciplined execution, strong organic growth fueled by smart hiring, and major strategic acquisitions underway. They're positioning themselves carefully in Florida's tough banking scene, but the market clearly needs to see that M&A integration land perfectly.
Yeah, their commitment to that fortress balance sheet and their clear plan for margin expansion are compelling. But the key for investors: meticulously watch the integration of Heartland and especially Villages, and see if that translates into the projected 10 basis points of core NIM improvement. That's the number to watch.
We hope this deep dive into Seacoast's Q2 earnings call has given you valuable, actionable insights. Keep those questions coming, and remember, staying informed, understanding the nuances, that's your best bet.
Absolutely. Always do your own research. We'll be back soon with another deep dive into the financials that matter to you.